What we see is that in the first half of the year, there was a demand which was well above what you would normally have, and basically the levels tapered a bit off, but are still representing a very solid demand. And so that's basically where we stand. We see that there is a demand. We are basically in good shape to serve them, and therefore we basically have stepped up our market share in these activities. So that's basically where we stand. And as I said, this is what we will continue to do. We are very solid, have excess liquidity, so we will be there to continue to serve our clients.
You mentioned the cost of risk saying 1.24 billion, so that's an improvement compared to the second quarter. And there's this general concern that we might see a sharp increase in not performing loans coming ahead, that so far things have been better than expected, but that it's not a question of if, but a question of when that we will see this increase. So how do you see things going ahead, especially now we see a second wave of lockdowns in Europe?
Yeah, well, if you look at the lockdowns that are being now rolled out in Europe, what we observe is that the authorities have drawn some conclusions from the one earlier this year. What I mean by that, what we often see is the civil service staying open, the construction sites staying open, manufacturing for a high degree staying open, services, of course, will work from home, but most of the service industry has learned how to optimize themselves in the previous one. So those are activities that the lockdown should be a tad different from what we have seen in the previous part. And as I said, the pickup in cost of risk that we saw in the first half of the year was for a major part forward-looking. Yeah, so it was in anticipation. So that's basically where we stand, and we'll have to see how things unfold.